Building on what we did in lesson 1, we are going to now look at contango and backwardation. You'll recall that we looked at, in lesson 1, we had looked at the term structure of forward prices there, and we even ended up drawing a graph there to try and explain the term structure of forward prices. And we are going to build on that model right over here. So we will be looking at a normal contango and a normal backwardation right there, right under that. We will move ahead and look at cost of carry model, where we'll be able to come up with a relationship that includes the component of storage costs right there. Then we will move ahead and look at forward prices and arbitrage. That. We'll move ahead and look at arbitrage-free pricing, and financial forwards. Move ahead and look at arbitrage free pricing of we're saying arbitrage free pricing of physical asset forwards. Physical asset forwards. And that is what is going to conclude our lesson for today. So we start off by looking at contango and backwardation. So we are looking at contango and backwardation here. And backwardation. There. So we can explain in brief what contango and backwardation is, and then we will build on that by looking at what a normal contango is and what a normal backwardation is. A contango, we can start by saying a contango, apologies, can say a contango refers, I can underline that, to a situation where the current forward price is greater than the current spot price. Yeah. Obviously, a backwardation would represent the reverse or the contrary opinion on this. So we are saying over here, in brackets, you can put where the spot price, the current forward price, so F is greater than S, like that. A backwardation line that refers to a situation where the current forward price is less than the current spot price. Spot price there. So we are saying what happens is F is less than S, like that. Now we had looked at the term structure of forward prices, and I can come on this other side. Just in brief to explain what we had looked at. We had looked at the price over here, and we had looked at maturity right under that. And we had drawn the prices trending to move like that, in that scenario there. So we're saying that a contango refers to a situation where the forward prices, the current forward price, or what we're saying, the forward price looking ahead is greater than the spot price there. That is where analysts or investors try to earn a return. If there's a difference between the forward price and the spot prices there, that's where now we are seeing analysts usually try to leverage, or hedge fund managers try to leverage on the differential between the forward prices and the spot prices there. Likewise, a backwardation is where the forward prices is less than the spot price. That can also be a scenario where you can try and earn a return that is very significant, and that can be able to lead to overall increase in value or increased returns to be realized by the investor there, or the analyst, like that. So now we move on and try and explain what a normal contango is and what a normal backwardation is. We can do that over here. We can say that a normal, and we can start with contango, refers to a situation where the current forward price, is greater than the future expected spot price. The key word there is expected. Unlike what we had said over here, we are saying a contango is where the forward prices, the current forward prices, is greater than the spot prices. Now here, the current forward price is greater than the expected. What you expect the spot price to be, that is what we're saying a normal contango refers to there. A normal backwardation refers to a situation where the current forward price is less than the future expected spot price. Future expected spot price there. And this is very important because we're saying, like I had said before, analysts usually try to find differentials between the spot price and the expected or the futures, the forward prices there. Now that differential over there is represented by the term structure of interest rates. So we quote the yields against the maturities there, so that you can be able to see how much yield for a given maturity, what are the yields on commodities yielding. Remember, there is financial forwards and there is what we're calling commodity forwards. Those are two different instruments. Financial forwards relate to or analysts who invest in financial forwards try to get some form of exposure when they invest in financial assets, including stocks, bonds, and the like that. But analysts who try, or investors who try to get exposure through physical commodities, we are saying those are the ones now who try and identify the difference in terms of the prices of forward prices and the spot prices, and you try and get some yield from that there. So that is it about normal contango and normal backwardation there. We move on and look at the cost of carry model there. But before we go to the cost of carry model, I can probably try and emphasize a small maybe graph right over here, where we will be able to try and explain a contango situation, where we are saying if you have maybe a given level price over there like that, this is what we're saying is a spot price there. Probably today's price. That's what we're saying. Now, if you're trying to say Contango, of course you expect the forward price to be represented by hard price, like that. Forward price is greater than the spot price. That is what we've demonstrated right over here. And this is very significant. Graphs also need to also be complete, because we are saying that here we need to plot the yields over here against maturity, like that. And then over here we have the prices. Like that. I'm just trying to relate it with what you've written over here, like that. What you've written over here, forward price is greater than the spot price. Right over here, you can see this is what you're saying. This is the spot price being greater, like that. Of course, the opposite will hold for backwardation. So here I can be able to say this is Contango. That. Now on this other side, I can be able to draw a graph that shows us how the backwardation scenario looks like. So here we have maturity, and here we have the price here. So here we have the spot prices existing like that, and now scenario like that, spot price, and this is the forward price like that. So this we're saying is backwardation. That. Now, having looked at this, it would be good for us now to move on and look at the cost of carry model. We are still building on what we've actually learned, the term structure of forward prices and the concept of contango and backwardation, which analysts try to seek, whether they're investing in financial forwards or commodity forwards or physical commodities themselves. That's what we're saying. We'll be building on that. And having looked at that,